we go. We are in Chapter 9 homework. Last one. Now this one's kind of interesting because a couple of things I want to teach or show you how to do. We're looking at a note payable, and this one is borrowing $120,000 in cash on December 1st, and it's a 180-day note. It's at 10%. And it has a face value of $120,000. First thing it asks you, when does it mature? Two ways to do this. You can, well, three ways actually. You can sit down and look at a calendar and count out the days. You can do a search on the internet and just type in 180 days from December 1st, 2015. It will give you a date. Or you can use Excel. So if I type in 12/1/2015 and I simply go to the next one and I do equal that date plus 180, it will give me the due date, 5/29. Now, what you have to be careful of in realizing that there are leap years, so always make sure you're using the year when you're doing that calculation. This one happens to fall into a leap year, 2016. If this were maybe 2014, we would have a 5/30 date on there. So the due date is May 29th, 2016. So now we know when it's due. Now we have to figure out how much interest we are going to pay for 2015 and how much we're going to pay for 2016. So you have to look at how much time do we have in each year. Well, this note is for 180, so the overall interest is a principal of 120 at a rate of 10%, and it's 180 over through. I'm going to have to, otherwise it's going to calculate it. So the overall interest is going to be $120,000 times 10% times 180 divided by 360. So overall, we're going to pay $6,000 in interest. But you will notice that we are going to have to adjust for year end. Okay? So this was our maturity, which rolls right here. I can see that. Let's just put that over here. Here's our maturity one. So you can see how you've calculated that. Now, how many days do I have in 2015? Well, December 1st to December 31st, that gives me 30 days, right? So that means this one is going to be 150. So now you can do the calculations from there. 120,000 times 10,000, 10% times 30 divided by 360 will give you the interest for 2015, and the same thing here, only using 150 days. They should add up to, obviously, $6,000 when you're done, we hope. So that takes care of the first part. And now you have to do these things called journal entries. So first of all, you want to recognize the note payable. Okay. Then you want to, this one for B is you're going to recognize the interest for 12/30/31. What is my interest expense and what is my interest payable? on December 31st. This is December 1st. So if I go 12/1, that should give me that. Then, when I go to pay this on, what is it, May? So 5/29, how does that break out? Now, again, you've got to remember, you've got this accrued from here. So, your payable is going to be credited for this amount. The remaining interest here is going to go in the expense. Your note payable is going to be debited because you're paying it off, and then the total of these three become your cash. So you want me to do that again? Let's use arrows to help you. This is this. When we go to pay it, this payable, oops, comes here. This interest expense that you calculate here goes right here. Your note payable, whatever it was for, that 120, will go right here. Oops, goes right here. You can get rid of it. So you're going to have the interest expense from here, you're going to have the interest payable from here, and you're going to have the principal maturity from here. So the total of those three will be the amount that you will pay to pay off that note. And that check figure should be 126. That should be your check figure. That is what would be the amount paid. So you should be able to kind of struggle through that. We'll go through this again when we get into class. So I'm going to save that with all the arrows. I hope that it doesn't get too confusing. Well, holler if it does. So that takes care of a note payable. This next one is just sort of an FYI for you. These are called accrued liabilities. These are liabilities that exist but haven't been recorded yet. So the first one talks about employees earning, employees earning vacation pay. So they earn one vacation day, and each day is $160. And there are, how many? Employees earn 20. So 20 employees, and they've earned one day at $160. So that equals this 20 employees times 160. So there's $3,200 in accrued vacation benefits that needs to be recorded. So you would do that as a vacation benefits expense and then as a payable. And then when you get ready to pay out your vacation pays, you would debit this. So they have accrued this much that has to be recorded. So that's one accrual. The other one is that warranty expense we haven't talked too much about. I'll kind of go through this, but you have 12,000 units that were sold, and they carry a 60-day warranty. So let's just do that 12,000 right there. That's units. The sales are 460,000. So I'll put that over here. I don't know if I'll need it or not, but just in case. That's in dollars. The company expects 10% of their units to need repairs. Aha. So this, I'm going to put down here, 10%. So, and each repair cost is going to be $15. So how do we do this? So I've got 12,000 units. I just need to figure out times 10%. That's going to give me 1,200 units. It's going to cost $15 a unit. So my warranty expense to be recorded is going to be 1,200 times that 15. Should be $18,000. And let's see how well we've done with that. So that calculates out. So then we have to record that warranty expense, and this becomes our estimated liability. Again, this is going to be sort of an allowance account that you'll play off against. So that's how you would record accrued liabilities. The next thing that we look at are employer expenses. And we've done this before, so I'm not going to spend a lot of time on it. You should be able to, what you're going to do is they give you scenarios. There are 3 scenarios. They give you limitations. FICA, anything over 117,000 is subject. Gross, FICA Medicare, anything gross, so whatever the gross is, that's what you're going to pay it on. FUTA is only $7,000 limit, and SUTA is a $7,000 limit. So what is it asking you to do here? So gross pay through August, so $6,000. Gross pay for September. Gross pay. Okay, so if I add those two together, what am I going to end up with? They want you to compute each of these 4 taxes as applied to the employee's gross earnings for September under each of the 3 separate situations. Okay, here's a hint. You're going to have to add these 2 together. So as an example, if the limit here is $117,000. I have a gross of $6,000, and I'm adding $1,500. That is not hitting that limit, right? So this, the September earnings that are subject are $1,500. Medicare says it's gross. It doesn't matter. There is no limit. So Medicare is going to be $1,500. FUTA and SUTA are $7,000. We already have $6,000. So I can only add $1,000. If I add these 2 together, it's going to go to $7,500. So that means I can go up to $7,000. So I will pay on $1,000 here and $1,000 here. And then you will take your tax rates right here for your multiples. And it should add up to $149.25. Now, okay, we're done with that one. You can do the same thing with this one. Limit is 117. You've got 18,000 here, and you're going to have 3,100. That does not go over that 117, so you're going to have $3,100 here. This is on gross, so it doesn't matter. FUTA, okay, you're already over that, so obviously neither are going to be calculated in. And then the final one you're looking at, you've got 103,000. You're going to add 20,700, so that means that's over that 117. You're going to have to do some calculations. So, and I'll let you figure that one out. There are your totals to be going for. Have fun with this one. Very last one here is you're just going to take the information given here and place them in the correct location. sort of a plug and chug. I give you these check figures, 580 and 116. That's what these credits should amount to in the end. Should come up with, hold on, let me find it here. You should end up with a salaries payable down here of 411,756. That should be a check figure for you. Then you need to calculate what the employee's tax is going to be here. You have to read this carefully. This is the insurance amount right here for the employee. This is the insurance amount for the employer. So I'll let you play with this. You've got check figures all over the place. So you're going to do, this is the employee's side of it, and this is going to be your salaries payable and your cash when you pay it. You're then going to look at the employer side. This is your payroll taxes. So you're going to pull that information out right here. You're going to, here's your benefits. That's going to be the life insurance and the medical. That's going to be that side. And then this is going to be the payment, okay, of all of the payables, including employer and employee. This is the grand total you're shooting for. So this one will be fun. We'll recap it on Monday. See what you can do with it. Okay, that wraps it up. Good luck.